This is the More Doors Podcast, episode 63. I'm here with my Force for Good partner in crime, Mr. Brian Force. We have an amazing guest teed up for us today. We're going to talk about road trips. We're going to talk about W-2s. We're going to talk about multifamily and all the things. We're going to talk about all that right after this. All right, we are back. Welcome back, everybody. Episode 63.
63.
63 for those Spanish-speaking listeners out
That's
there.
really, really
You
good.
like that? Lady would be proud.
Lady would be proud. Did I tell you that I started Spanish lessons officially yesterday?
That's amazing. Did you learn 63 yet?
I already knew that one.
Okay.
So it's actually, interestingly enough, so they give you a test beforehand. You do an intro call. So I paid for a year up front because I was like, you got to just go full immersion. Don't go monthly because you'll get busy. So if I put my money on the line, I usually stick with things. And then they do an intro little onboarding and they test you. And 12 is like total fluency. 1 is obviously beginner. I was only a level 2. So that kind of hurt, but I wasn't a level 1. But then I got into my first lesson and level 2 didn't feel so bad because it's not like, it's assuming that you already have vocabulary and stuff down. Like this is kind of a higher level lessons. So level 2 is like level 2 of actually being able to converse, not level 2 of like you're still learning hola and stuff like that. So I felt pretty decent about where I was. I got a lot of homework. I haven't had homework in a while.
Let me ask you a question and be honest. Did you say to yourself, like, damn it, I memorized my wedding vows in Spanish and I still only got a 2?
Yes. So there was definitely, I was hoping for like a 4 or 5 and we'd be, but the biggest thing is that when you are as immersed in another language as I am, being in a family that only speaks that language, your understanding of the language goes up very, very quickly over the years. You can understand most of what people are saying because you're only picking out verbs and nouns. Any keyword, you get a verb and noun in a sentence, and obviously you know like negations, and you know whether it's yes or no. You're going to understand about 80% of what people are saying really quickly. When you respond to people, the articles and the conjugations and all that stuff changes the meanings. So my ability to respond back is not nearly as good as my ability to understand. So I always felt maybe that I was better at Spanish because I can pretty much understand it. Returning the serve is still a little bit challenging. I was a little disappointed with where I was.
That's all right, buddy. There's a room for growth.
Yeah. It's just,
and that's what we're here to talk about, right? Growth mindsets about things. Speaking of languages, let's talk about the language of our sponsors before we introduce our guest.
We got to give credit to the people that pay the bills around here. That is the people over at Deep Blue Capital. There we go.
You like that?
Repping that brand today. Check out.
Don't have my hat.
That's true. We got a whole box of them. We haven't given. Jesse's a hat guy. We never gave him a hat, dude. Unbelievable. Check out deepbluere.com. That's the home of Deep Blue Capital. Please go and create your investor profile over there. You'll get early access to all of our upcoming investment opportunities, as well as a whole bunch of educational content. And then head on over to Tor Studios. That's TORE studios.com. That's where we're sitting right now. Jesse Showalter will hook you up with all your content creation and podcasting needs. Check out tourstudios.com.
Well done.
Thank you.
Good job. Should we mention that Jesse's beard is very Santa-esque right now, except it's not white?
I mean, it's getting there, but
Do you think Jesse will be Santa later? Not actually Santa, but like, do you think Jesse will moonlight as a volunteer Santa later in life? You know,
maybe at the children's hospital or something.
If you first a gray, you know, and it becomes, you know, I just think you would find a lot of joy in that.
Gotta gain some weight.
Gotta gain some weight. There's suits for that.
There's definitely suits for that. I played Santa once. Story for another episode.
Oh, nice.
Anywho, let's introduce our guest. Our guest, very accomplished real estate investor, chemical engineer, has been known to get up at the crack of dawn to work on his fitness and just got back from like a 2,000-mile road trip for managing his assets and doing on-site inspections. So can't wait to hear about all of that. Mohit Chopra from MV Capital Group, welcome to the show.
Thank you. Thank you, guys. Happy to be here and appreciate the opportunity to share anything I can.
Appreciate the time, man. Let's just dive into it. Like we kind of said before, we hate just reading people's LinkedIn bios and stuff. So in your own words, help us get to know you a little bit. Give us your background. What do we need to know about Mohit?
So, well, starting out chemical engineer with a background, and I would say like most of the people who are getting into real estate, who have been into real estate, started out with a W-2, have been thinking about the journey, always thought that W-2 will bring the independence, and what we expected doesn't really happen. So when you realize and have that moment, which moment happened for me was in 2017 or 2018 timeframe, and started working on looking at what are the opportunities that are there. So started building my real estate, and like most of the people, started with single families and quadplexes, then eventually learned it's going to take forever to get into the cash flow that I need to build future, I guess, generational wealth. So moved into multifamily. I've been in multifamily for 4+ years now, and loving the journey and the hustle.
Wow, that's excellent, man. So take us through, obviously you started on the single family side like most people do. What did your first couple of single family deals look like? And then what was what was the cause of that mindset shift around single family versus multifamily?
Yeah, so the first deal we did, so it took me about, again, sometimes I would say in being an engineer can be a strength, but sometimes it can be reckoning as well, because in my case, it took me about 6 months to understand and hone on the market. I did like a spreadsheet of 60 different markets. Finally, it took me 6 months to identify 5 markets. We closed on the first deal after 7 months of just looking at the markets. That was getting into real estate. I'm not even talking about multifamily yet. So analysis paralysis, sometimes it can be an issue if you're really, I guess, from an engineering background. But luckily I was able to get through that. We closed on the deal. Again, we identified the first market we closed in was in North Carolina. Luckily at that time, the numbers made really good sense. The market was booming at that time, like coming up. It wasn't at the same rate as it is today in terms of purchase price. So we were able to accomplish what we really needed in terms of being able to reposition these properties, implement the BRRRR strategy, where we purchased the property at significantly, I would say it was like 1.5% of the purchase price. So for those who don't know what I'm talking about, we purchased the asset at $75,000. The rent over there was about $1,200. So all in cost, 70,000 purchase, 68 plus 10, 78,000 total, all in cost, 10,000 rehab. And we were able to get the tenant in, get it leased, and within 6 months, we were able to get the money out. So that was the first purchase. Then we tried to get into quads and duplexes. We did some of those. And again, it's just that every deal takes so much time and effort. We realize it's going to take forever for us to generate significant cash flow that we need. It's only a few $100s per unit that we were able to get. Mm-hmm. So the volume wasn't there to sustain what it will. I did the calculation, of course, like everything else. And I realized it will take me 11+ years of doing this to,
Yeah. You had the realization that most multifamily investors do, because most people do start in single family, that your return on time is substantially lower in the single family space, because the amount of effort it takes to close one deal doesn't scale proportionally, meaning it doesn't take 300 times more effort to close a 300 unit multifamily deal as it does to close a quadplex. It takes maybe a little more time. You've got due diligence, you've got lawyers involved, you've got all those types of things. But whereas it might take the exact same amount of time to close every single individual single family home, it might only take about 20% more time to close a larger multifamily deal. And so when you look at your return on time, your scalability is much greater in the multifamily space.
Absolutely. And that's exactly the driving or the shift that I had in about a year and a half into real estate. And I delved right into multifamily. They joined 3 different groups, including Jake and Gino, my first meal in multifamily. Started looking at basic education, because again, even though it's real estate, there's substantial difference in terms of underwriting, in terms of understanding the cost factors, right? So took me, and again, another 6, 7, actually 9 months of learning before we were able to acquire our first asset in multifamily space.
So you immediately jumped into communities that could help you kind of cut that learning curve from somebody who's got an engineering background that admittedly can take a little longer to come to the action part of it as you stay in analysis mode. How valuable do you feel like getting coaching and joining those communities was on your ability to compress that timeline to your first deal?
I would say it's unmeasurable in terms of, I would say it certainly cut down the learning as well as the, apart from the learning perspective, I would say it cut down at least 1 to 3 years of what I would have learned, and maybe thousands of dollars I would have lost myself in terms of some of the nuances when you delve into real estate on a multifamily side. So that's certainly one aspect. I think the other aspect that people don't give enough importance to is the community and the partners that you build, or the partnerships that you build from those communities as well. All of my deals and my partners, and now working with one partner, have come through those communities as well, right? So it's not like I'm going to go, and this is the other aspect, right? Because again, when you buy multifamily, you are building a team together, you are finding partners, and in order for you to be able to go into a deal that's worth multi-million dollars, you need to have a certain level of confidence and some level of working relationship with the partner as well. And so these groups become a good, I guess, starting point to build those resources, build those partnerships also. I think that's actually more valuable than the other things as well.
Let me jump in here with two quick questions that come to mind. So you mentioned up front that you had like 60 or 70 markets on your spreadsheet. You narrowed that down to 6 markets. That was when you got started in single family. When you made the pivot to multifamily, did you stick within those six markets, or did you adjust somehow?
So we did adjust as well. So again, the analysis on the multifamily was a little different as well, because again, the way that the numbers work on multifamily is not similar to single family, right? So in single family, it's more about overall appreciation in the market. In multifamily, we had to look at cap rates and other aspects that are not really appreciating along with the market. So we looked at other markets. So in order to diversify, we had to identify 3 different markets so that we can balance our portfolio. So we had a growth market like the Carolinas, and we also had cash flow market, which we added, which was Ohio, which I actually own a lot of my portfolio in Ohio market right now.
Got it. Okay. So I didn't take away there, right? What's good for single family is not necessarily good for multifamily.
It's funny that when you asked that question, I had a similar question. I just assumed the answer was you went all the way through the analysis loop again for that particular reason, you know. And you know, it's interesting that you'd even kind of go through that on single family in the first place, only because most of the stories and journeys that we hear, when you go and you start single family, it's usually just where are the deals that are already in your backyard.
Mm-hmm.
So having that foresight to even do that on the single family side, I think is really, it's a really good step forward. When you can start to analyze markets, there's always deals out there, and you really limit yourself to a really small subset of the market if you're only looking in your backyard. So having that analytical mindset is certainly a blessing in that regard.
Totally. Speaking of analytical mindset, that's a perfect segue, my favorite word on this show, to my next question. So Mohit, my good friend, dear friend, Mike, right? I've done 10 deals with Mike. We all did a kind of co-GP syndication 6 months ago. He's got an engineering background as well. And I think what made Mike and I successful, but also creates its fair amount of conflict, positive, healthy conflict, is the fact that Mike is very much the analytical, right? C or even S, right? On the discs profile. I'm the influencer sales guy, right? And that kind of creates some really good chemistry for the most part between us, right? We definitely see things differently, but we also hold each other in check because of those various personality types. You having an engineering background, going into these communities and ultimately finding people that you wanted to do business with, like, what were you looking for and what did you end up with? Did you find people that were like-minded and similarly analytical like you, or did you find folks that maybe had some, different types of personality traits that you thought were good to partner up with?
That's a very good question. I think if I answer it honestly, I think what I went in was a different perspective, but what I actually ended up looking for was different as well. When I went in, I was looking for all the complementary skill sets, something that I'm not good at. But eventually what I ended up looking at is, apart from the complementary skill sets, I think the first thing I realized, looking at some of the horror stories in the partnerships as well, is the first piece that has to be there is alignment of your key principles, right? Like, what are you as a person and a human being, and what are your key principles without which, or again, you will not go against those, right? So I think that was the first thing I realized. I had to make sure that those were aligned. And then after that, we did look at complementary skill sets, similar background, but more importantly, what is the long-term vision and future that we're trying to build? Because there are different ways. Every deal, every opportunity has a different way to make it work based on the time horizon, as well as what you're trying to get out. I mean, there are, people who have done wholesale, people who have done flips, people who have done even on multifamily space as well, who have 3-year hold, who have done syndication, people who have done JV structure. So you can fathom the multitude of different opportunities that you can work, but what makes sense for you and your partner to collaborate on. So that was the first piece that we looked at. I did work with few syndication opportunities earlier, but soon I moved into JV style, smaller, mid-size multifamily deals. And that's how I build more collaborative, partnerships for people who are looking into the same space and had same vision about what they want to accomplish in the next 2 to 10 years time horizon as well.
Very interesting.
So what does that look like a little bit in your world? What, as far as your intention, what you're looking to accomplish over, whatever time horizon, what is the time horizon, I guess, that you really are focused on, and what is the end game for MV Capital?
So at this time, I think when we started, we always started with a 5-year plan. We are year 3 into our 5-year plan. We are actually on target right now. And now, again, that 5-year plan evolves every year as well. So now I still am working on a 5-year plan that goes on until 2029. In the next year, so far, we have built our portfolio in the JV structure where we own 50% of more of all of these assets. We have 9 different properties across 3 different states. We are continuing to expand into these 3 states, which are Ohio, North Carolina, and Kentucky. We are expanding into Tennessee as well. So the next 1 year, the focus is on the next 2 years. This year, our target is to acquire 150 more units in the JV structure. And then by year 2026, we are planning to have 150 plus 250 more. So with 400 in the next 2 years. That's our strategy and plan so far.
Fantastic. And it sounds like you guys are on pace up to this point. What's attractive to you? We talk a lot on this show, and I actually appreciate you bringing that JV mentality as opposed to some of the more of a syndication style mentality. What is attractive to you about the JV structure as opposed to syndication?
So, I mean, there are a lot of moving factors there. And again, I'm not going to say the syndication strategy doesn't work. It works for certain people, again, depending on what you're trying to get out. Again, from our perspective, we had working capital to get started. So I think that's a basic starting difference where we have initial capital to put in so we can take the deal internally within our partners. So we are able to put that initial capital, take the ownership of the asset, number one. And number two, more importantly, I think we have a better control between the two partners that own these assets to be able to manage the asset appropriately, implement our execution strategy appropriately, pivot. And that's, again, it's the reality of the real estate as well, where you can create all the plans, but you have to be ready to pivot as well. So when you pivot, you only have two partners to collaborate and work together and align on the strategy. And that's certainly something that really has worked really well for us. Where, again, just because of the fact that we have a common alignment on the long-term future as well as our strategy, that it doesn't really take too much time to pivot or alignment on a pivot to a strategy based on what we see and some changes that we see in the market after acquisition during the execution stage of our business plan. So I think those two factors really make our direction into smaller JV style structure. And again, number one, we could do it because we had initial capital, and we haven't taken any money out of our business so far. We just keep putting it back. Again, every 12 months or so, we are able to reposition, take the equity out, reinvest back into the business as well. And that's how we have been able to build our portfolio during the last 3.5 years.
Love that. When you decided to pivot, Mohit, and go into multifamily, why did you think that Ohio, Kentucky, and North Carolina were good markets for you? And then, why the potential expansion into Tennessee?
Right. So again, good question. And in my perspective, it was more about what makes sense for me and our strategy. So when we looked at analysis, like I said, we had to balance out the cash flow as well as appreciation. We didn't want to get fully into appreciation only because, again, there's a lot more risk riding into it because there are certain macroeconomic factors that might not or might delay some of the execution as well. So you can't really put all your eggs in one basket of relying on appreciation only. As we know, the interest rates, for example, what we expected in 23 didn't really happen in 24. So those kind of things can impact what kind of or what level of appreciation you see across market from a cap rate perspective as well. So we wanted to balance it out, and that was the reason we wanted to get into Ohio and Kentucky. Ohio, I think it just, again, sometimes I would say when you start out, you try out 2-3 different markets, which is what I did. I had Ohio, Indiana, and one other as well. And it just happened to have my first deal ended up being in Ohio. And since you get to first deal and you build those connections and you continue building and you expand in the market, you build your connections with brokers, property managers, general contractors in the area. And that's how it started. So it wasn't that Ohio was the only market in Midwest. We had 3 different markets within Midwest, but it was like Midwest region for cash flow purpose. And once we had our first deal, we continued to build onto that momentum and also build a team there in that region.
Love that. So when I think one of the big differences between syndications and JVs, right, is when you pull out the GP-LP split, the inherent return profile goes up. Now, you mentioned cash flow or the right balance of cash flow and appreciation in your return criteria, your return model.
Right.
What kind of targets are you looking for? Assuming a 5-year hold, like what's your cash flow target and what's your overall return model look like?
So our basic fundamental, the way we work with, we basically buy large value add opportunities. So apart from the cash flow, cash flow, most of the cases is infinite because we are able to take all the cash back within 12 to 15 months in most of our deals.
Wow.
What we look for most is yield on cash, which gives you a framework of how much total all-in cost that you're putting into the property, and what is the yield on the back end when you get the entire capital back. What is the general cash flow you're going to get after you have no money left in the deal? So we have some other key metrics that fit more towards our model. That's not really something that might be worthwhile even looking at for syndication perspective, because again, syndication deals have a lifespan. What we are working on a JV, we are not putting deals in a certain lifespan. We take the deal, we reposition the asset within 12 to 15 months. We take all the initial capital invested out, and we generally cash flow. And that's the beauty of JV, that we don't have to sell the asset. We just take the initial capital back, and then we cash flow after that. But from a model or from a key metrics perspective, yield on cash is one. We normally look for cash flow per unit after refi. I mean, that's what our main motive is in this entire venture, right? That we're trying to build cash flow. So how much is the cash per unit we are able to get after refi? That's one of the important metric that we look for. So that's the reason sometimes we take on heavy value add opportunities, because our basis going in is so low, even with the capex that's required, that it provides more upside on the back end, because again, you have increased the value of the asset so much with the capital that you have put in, that you're able to not just take the money out, you actually sometimes get more money back as well, and you cash flow substantially much more. Our target is after refi, $200 to $250 per unit per month. Sometimes we're able to get 150, sometimes 250, sometimes 300. And those 200 plus deals are rare now, but we still have those targets, and we still try to see what closest we can get to those targets.
Yeah, that's a really, really, that's a deep dive. I hope people pull some really actionable stuff out of that. We use a lot of generic terms like, equity multiples or cash flow or things like that when we talk about multifamily real estate. You just brought up two really key terms: your yield on cash and then your cash flow per door. Those are metrics that are incredibly important that I think get overlooked a lot when investors are looking at comparing, let's just say, a couple of different deals that they might be interested in doing. If you're getting you could get, let's just say you can get $10,000 worth of cash flow a month out of a lot of different deals, but how many doors does it take, and what is your input into getting that cash flow? That's going to have a direct effect on your scalability and your ability to continue to build your portfolio. So having that eye for yield on cash and then your cash flow per door, it's very similar to the mindset of just talking about AUM versus other metrics, right? Like getting a little bit more granular with what you're trying to accomplish on a per unit basis. It feels very dense to look at all those things, but it is how you're going to scale your portfolio over time.
Totally. I love all those, different return metrics that you're looking at, Mohit. Like, we haven't really talked about, yield on cost at length in the show. One of the things that we have been hearing a lot about recently, though, is this shift away from value add assets and towards more B plus A class product, where they're, you're really looking for just more of a stabilization play and lower risk on dollars invested. What's keeping you and your partners and your team interested in value add opportunities in this part of the market cycle?
So that's a very valid question. And now I would say that's the value add opportunities are still our bread and butter, but we have looked at and we have acquired some of those assets as well that are more repositioning play as well. So again, when I say value add, I got to explain the value add comes in two different forms. One, you have a big capex to reposition the property. And the second, which we love, everybody wants to get those, is the management play, right? Like where the asset itself is in a good class B state, in a class B or C area, even class B or A area. It's a good standard housing, but it's just as way under market. And we have acquired few assets like that because, again, these are smaller assets that were owned by mom and pops, owned it for 20 plus years. They maintained it well, but the rents were $400 under market. So for those assets, we didn't really have to put much capital into repositioning the asset. We had to pivot a little bit in terms of management strategy with regards to how we are marketing those assets, how we are getting the tenants at the right market rate, establishing the market rents based on study that we did to make sure that we are not way above market. We were on at market rents, and we still were able to achieve 300 to 400 rent bumps without putting crazy amount of capex. So again, that's second type of value add strategy as well. So I want to highlight that we do have both type of strategies, like we do both type of assets that we buy, where there are some of them are stabilized assets that are not in need of major capital. It's just repositioning the asset in the state where it is, marketing it better, getting better property management in place, and taking care of very little delayed maintenance if there is. But to your point, we have looked at both aspects as well. If you look at in generality, though, some of these Class A and Class B assets will give you more, I guess, lesser risk with regards to delinquencies and other aspects. But the upside is limited in those aspects as well. So it's almost the same thing we always talk about, risk and reward situation. So the risk might be minimal, but the reward might be in the same line as well. But we need to find that, we always try to find that balance where we have an appropriate level of reward as well, because that's how we are able to refinance within 12 to 15 months, take our capital and deploy it for the next asset.
Love that.
Makes perfect sense. So in regards to that, I definitely wanted to dive into this story. You guys are obviously very hands-on with your asset management. Tell us a little bit about the journey you just took. It sounds like you had a whirlwind of a couple days checking in on a lot of your properties. Give me an idea, what was the purpose behind this, and then kind of take us through the journey.
So let me start with this. I live in Philly suburbs, and like I said, my majority of my portfolio is in Midwest. So I do this every 2 months or so, where I take a road trip. I start from Philly, go down straight into Cleveland. I have about, a few hundred doors over there. So I have 5 different assets there. I do a walkthrough of my assets, at least on the exterior, and every 2 trips on one of the assets. So this time I had 2 assets where we had scheduled walkthrough on the interiors as well of some of the units. We have some Section 8 housing as well, and we make sure that every Section 8 unit gets walked through once a year as well. That's part of this whole schedule that we have in place of our asset management walkthrough. And then from Cleveland, we go down to Cincinnati, where we have other assets, and then into Kentucky. So if you think about this road trip, going all the way from Philly to leave about 2 o'clock in the morning, get there around 8 o'clock, start day 1 in Cleveland, most of the day in Cleveland, then finish the day in Cincinnati, and then stay night. Next day, drive over to Kentucky, spend half a day walking through the assets, and then drive back home to Philly, 12-hour drive back.
Ooh, man.
The Iron Man. I love that. That is legitimately the Iron Man of asset management right there.
100%.
All I will say is this, though. Again, it's not like I'm a superhero. It's just that I know that even though I have good property managers, nobody care about your assets like you do, right? Like even this time I identified we have renovations going on in the 21 unit in Kentucky that we are repositioning. We have a great general contractor who has worked great wonders for us, and he has done most of our assets across Midwest. But again, we go there, we identify issues that, again, we go with fine tooth and comb, because it's my asset. I got to make sure when we are paying what we pay, we get the value out of it. And similarly for existing assets, we want to make sure property management is maintaining them well. If there's, like this time I identified one of the assets, we didn't have the fall clean through. Like there was power washing wasn't done. So we reached out immediately to the property manager, send them pictures, and that's taken care of actually today.
Nice.
So how do you set those expectations with your property managers, right? I think there's I think we're very hands-on with our property management team. We're constantly, finding gotchas that we're like, we didn't talk about this up front, but we need this done. So what kind of expectations do you set with your property managers, knowing that your assets are anywhere from 6 to 12 hours from your home?
So yeah, so one thing I would say, and this is part of one of the biggest learnings I got. Again, we talked about communities, right? When we looked at in Jake and Gino multiple coaching sessions that I did, one of the things we learned how important it is to have your eyes on your assets very frequently, and that's what we are doing. And the main thing when I started working with property management or hire new property manager when we started out in Ohio, for example, we clearly listed out what our expectation was. Number one, as we go through repositioning, during repositioning, because we are going to have new units coming in on the market, we have a lot of new tenants coming in, we are going to have a weekly call. So that's one expectation I put up front. Second, after the property is stabilized, depending on the time horizon, if it's during refi or before refi, we still have bi-weekly calls with them. So the expectation is set up front that what I expect is because again, property managers come across different type of owners as well. There are a lot of absentee owners, there are owners from all over the world, and there are owners who have brought their properties down to the ground because they don't spend enough capital. So they come across all different type of property owners as well. So we clarify up front, we are hands-on type of owners who will spend the required capex, who will visit the property. So they know they prioritize the work for our properties compared to some other owners who are never going to be on the asset or don't spend enough capital. So level setting the question was really relevant in that sense. Level setting is critical when you set up your first relationship with your property management company. So even now, for all of our assets, we have at least a bi-weekly call to go through high-level numbers and also key KPIs that we have in place as well. And then on top of that, when we go during our asset management walkthrough, we let the property management company know in advance so they can give the notice to the tenants so we can walk through the units where we need to do a walkthrough inside as well.
2 follow-up questions to that. So let's pretend that Brian and I are flies on the wall for one of your weekly or bi-weekly calls with your property management team. What are the KPIs that you're expecting them to report on, and how do you run those calls?
Yeah, so number one is collections. That's the first important one. So the second week call is about collection, because by the 14th or so, it's always between 10th and 15th when we have the second week call. So that's all about collections. Where are we in terms of collections? Who hasn't paid? Where do we have to put the notices out? So that's one. And during that call, we also look at and the second week, it's about looking at expenses, looking at other KPIs, which is upcoming unit turnovers, the leasings, where the leases are expiring. Are there any leases coming up in the next 60 days? So we give them not 30-day notice, we give them more than 30-day notice in advance. And we also work on the strategy for those lease ups as well. What is going to be the new rate? What is the market condition looks like? And then also we have, again, property health scorecard, which I've created in terms of understanding how the property overall is performing, including tenant satisfaction, percentage of renewals that we are getting, and also some other aspect, which is around when we have some of the cities, we have annual inspection from the city as well, how we perform on those are there. And also we have some Section 8 tenants. So when Section 8 comes in, for the annual review or annual inspections, are there anything identified? Why weren't these caught up front? So that's like week 2. So week 1 is heavily focused on the top line. Week 2 is bottom line, as well as other aspects of the other KPIs, including leasings.
You guys are obviously very optimized in what you do. We don't ask guests this a lot, but I think we should. What do you use to keep everything organized? Like, give us a basic idea of like what your tech stack looks like, and kind of how do you run the entire thing?
So this is one thing I would say I'm focused on to improve. We are not really there in terms of utilizing the advanced platforms that we have available. We are still exploring that. Right now, it's all Google Sheets and graphs that we have in place. There's some automation that we've created within our Google Sheets. For example, it automatically highlights and populates for us when the rent roll, for using the rent roll, if there's any leases coming up in 60 days. And there are other aspects that our property manager fills in manually for these asset management sheets that we have in place. We are exploring 2 or 3 different systems. We are also looking at some of the AI tools to be able to utilize it more and maybe more efficient as well. I mean, that's one thing I would say. That's one of my key goals for 2025, to make it more automated.
It's an interesting time to be looking at what the future of optimization looks like, because like if you're in Mohit's, kind of situation right now where you're still starting to kind of build out your stack, the AI tools might be the perfect time to pump the brakes a little bit and see what power AI brings into the space in the next 18 months. I just think there's going to be so many things from KPI measurement to even underwriting that are going to get so much quicker and so much faster. Like, we've already seen some AI underwriting tools that are so, but I think they're going to get so much better.
I agree.
I think it's going to get crazy.
And you know what the scary part about that is? Nick's going to use ChatGPT to find out the answer about how AI is going to make investing in real estate better.
Nick's going to use ChatGPT to not have to do podcasts ever again. We're going to get a blow up doll with a deep blue capital shirt. He's going to speak, and it's just all going to be ChatGPT.
Nice.
It's funny you guys talking about that. I saw an actual podcast that was automatically, like, AI generated, and there sound like 2 people talking. Like,
yeah,
that's
you're watching it right now. We're not actually here.
It's getting really good though. There's a whole lot of existential questions around that. But yeah, even podcasts, it's pretty crazy how intuitive those things are.
Agreed. So Mohit, I wanted to, we're coming up on time here. We want to be respectful of your time, but I did want to hit on something that I think is very unique. And Brian and Nick and I, we've kicked this idea around a couple times. We haven't really taken a whole lot of action on it. But one of the things I admire about you as who I believe to be a very successful real estate investor is that, you value fitness, right? And we were kind of joking before the show that when I get up at 5:30 in the morning and I'm having my first cup of coffee, checking my Facebook feed, that I already see your gym selfies on Facebook. And I'm like, I got to step up my game. So tell us a little bit about how, fitness kind of comes into your life and how much of a, kind of critical success factor you see that being in your day job and your family and your real estate investing journey.
Yeah, no, absolutely. And again, I can see it. You guys are pretty fitness enthusiasts as well. I can see from your conversation that we had earlier as well. But I think what it comes down to, one thing that people often don't talk about is how the journey is not always that fulfilling as it seems when you go on to this real estate or any entrepreneurial venture, right? There are certain aspects or certain times when you don't have everything going in the direction that you anticipate. So not just from a physical aspect, but from your mental health aspect, the keeping your fitness up front is the only thing that will help you to not just continue on the journey, but make this journey longer and sustainable as well, right? So a lot of people get burned out. A lot of people I've seen have retracted very quickly as well. But from my personal perspective, I started this I'm not like a gym enthusiast since my 20s. I started when I became really overweight at about age 38, so about like a few years back. And since then, I've been, I would say, continuously, like at least 4 to 5 days. There have been some times when I have some injuries, but other than that, I've been pretty consistent about it. One thing I realized early on is the reason I go early morning, I wake up at 4:30 in the morning for that reason only, because that is the only time I can give for myself and I can control that schedule. There are not unknown calls or calls from property management or anything else that's coming in at that time. And also I have my W-2 that I do early morning calls while at the gym or after the gym as well. But that helps me, number one, keep my sanity intact. Number two, also get that taken care of without having the risk. And if I don't do it in the morning, it's just never happens because something will come up, some new call, some new issue, something else that I will never get time. Again, it's just my personal schedule that works that way. Some people are able to find that time. But the key piece is whatever time works for you, make sure you're able to dedicate that, because again, it's not just physical. There's a lot of mental health associated with your physical health as well.
I could not agree more, man. We could do an entire whole other podcast episode just about this, but you just said something that was really key. Find what works for you. I wrote an article about this last week. I call it your dominoes. So we all kind of have our perfect version of what our morning would look like. If we, mine is, wake up, get to the gym, it's healthy breakfast, making my healthy lunch as well. And then it's my reading, it's my meditation, it's my journaling, it's like my Spanish lessons, but it's like a 3-hour routine, and I would say about 60% of the time do I get all that in. There's this whole 40% of the time where, like, I told you we talk about Wicked on the show. I was out late last night. I saw Wicked. So I didn't get to bed till late. And so I have what I call, when we talk about what works for you, I just have my dominoes. My dominoes are like, I'm not always going to get my reading and my journaling and my meditation in exactly the way that I want to, because life has a lot of variables. But you have your dominoes. The dominoes are just your non-negotiables. For me, it's exercise and then a healthy breakfast. If I can just do those two things, you see just a complete difference in how your day unfolds. Your mental clarity, your ability to make decisions better. My ability also just to not feel like something is looming over me, because fitness is very important to me. And the times where I don't work out in the morning, like Mohit just said, like, I already know there's a good chance it's not happening later on, because after the day starts to get going, I'm like you. I'm pretty much going all day until I'm about to shut it down and go to bed. And my mind just works that way.
Yeah.
So I think we put a lot of pressure on ourselves and society, and this kind of productivity industry that we have developed puts a lot of pressure on you to, like, if you're not doing these 50 things every morning, like, you're kind of a loser. And it's like, no, like, have your dominoes, the things that are important. For me, it's just exercise and a healthy breakfast. Everything else is great. But if I don't get to all that, it's okay. I just got to get my blood pumping, and I got to make sure that I'm fueled up. Everything else will start to fall into place.
I completely agree. And for those paying attention to the show, I just want everybody to remember that Brian just started his Spanish lessons yesterday, and it's already part of his routine.
So, yes, and actually, that's funny. Brian made a much bigger commitment. I've been doing the apps and all this crap for years, and I'm telling you, man, if you don't
and still got it too.
This is actually a really great. We could go down a whole nother rabbit hole here, which I'm notorious for, and we won't. But, like, this is a great example of finding the right people to model after, the right coaches, the right mentors in your life, and then going all in and getting some skin in the game. Having a $30 a year app that no one knows whether or not you're even using it is not the way for me to get things done. Having a coach who's going to spend 2.5 hours a week with me, give me homework, and be there on a schedule that he and I have mutually agreed upon, and spend a lot of money on it, I guarantee you this time next year, I'll be speaking a whole different level of Spanish. I'll at least be to level 3, which is more than the apps got me for 8 years.
I love it. Mohit, we are coming up on time here, my friend. This has been an outstanding show. I appreciate you sharing all your wisdom and insights with us. I'm going to put you on the spot for a second. If there is anybody listening to the show that is, looking for some guidance or some inspiration or some words from someone who's seen some success in real estate investing, give us 1 or 2 actionable tips for people that are looking to really kind of step up their business in either, entrepreneurship or multifamily real estate investing.
It's so one thing I would say, what I've learned, and I actually have leveraged that as well. When you're starting out, sometimes you feel like you don't have any value or anything to contribute. There's always some value or certain thing that you can bring. You just have to dig deeper. Sometimes it's time. Sometimes it's your prior experience. Sometimes it's your hustle to be able to do the work. And if you find the right partner where you are willing to give what they don't have, which might be time, which was in my case in my first multifamily deal where I partnered up with an experienced multifamily investor. You find the right thing that you can contribute and work on that and build that partnership. You will always find a way to work it through. So don't give up just for the fact or keep working on it. Find the thing that you can contribute and find the right partner that will value those aspects and build a partnership that way to get you to the next level.
So true, man. So true.
I love that. Everybody's like, I think there's such a focus on, money and deals and relationships. There's plenty of time. There's plenty of people that have those things checked off. They don't have the time, and time is just like the one thing you can't make more of. So like, don't underestimate the value of time. I love that.
Yeah. Time, hustle, work ethic, those are a currency of their own. So use those if you've got them and you don't have the others.
Amazing.
Yeah.
True.
Mohit, thank you so much for hanging out with us and taking the time. Where can people find you and connect with you?
I'm on Facebook, LinkedIn as well. Mohit Chopra, you will see, you can just Google Mohit Chopra, MV Capital. You come up on Facebook, LinkedIn, Twitter. I can send my all three social as well. We can put it on the podcast as well.
We'll drop the links in the show notes. Check out MB Capital. Connect with Mohit on LinkedIn or all the different socials. Make sure you check out deepbluere.com, the home of Deep Blue Capital as well. And then TOREstudios.com. Last thoughts, boys. 63 in the books.
This was awesome. Thanks so much, Mohit. This was great.
Yeah.
Thank you guys. Appreciate you guys inviting me.
Appreciate the time.
Great.
We'll have to have you back at some point, hear more about your journey.
Yeah, when you come to Dallas, man, come to the studio. We'll grab an old fashioned.
Absolutely, would love that. Yeah, we got to talk about old fashioned today.
We'll do some. I'll make you a deal. We'll do some on-air old fashions when you come to Dallas.
There you go.
We'll have Jesse mixing them
We're
up in the back.
63 episodes in. He's never said that before. Mohit, you got the magic, bro. That's it.
All right.
You got the best out of him.
Thanks for listening, everybody. We'll talk to you soon.